Welcome to your Mortgage Minute. Today we're going to talk about escrow analysis on an impound account. When you first get your loan funded, you'll be given an analysis up front of where the money goes. How does it flow? When you have an escrow account, your mortgage payment includes taxes and or insurance and PMI. So if you get a fresh loan, they're going to have to tell you how this breakdown works. And then every year, they're going to break it down again for you to see if anything changed. Mostly what changes is your property tax goes up a little bit. So they recalculate the money needed to be put into that escrow account to keep it flush so that they can pay your tax bill and insurance for you. So we start off with an initial escrow account disclosure statement. We also call escrow accounts impound account. So here's a fresh one on a loan that went through on June 5th. It's a monthly payment. The monthly payment is $34.84, of which $26.65 is the principal and interest, and $8.18 is going into the impound account or escrow account. So this person's mortgage is $2,600 to the loan, principal and interest, $818 for the impound account, which includes taxes and insurance and PMI. So here it shows on the very first payment due, August 1st, $818. So the account is starting off with an initial deposit at the close of escrow. This person deposited $25.45 into the impound account, and every month the money is set aside. The $818 of the mortgage payment is set aside into this account. And you can see the balance here, escrow balance, is growing every month till there's a disbursement of the property tax bill November 1st, which is due November 1st. So you can see how 818 is going in, and that same month, 8/1, the PMI is disbursed. So money came in, money was paid out just for the mortgage insurance, and here's the new balance. So it's an accounting of where your money goes. So you can see again, she paid $818. The money was dispersed, same on September. October, the same thing happens. $800 goes into the account, $181 spent on PMI. So the remaining balance in that account is $44.56. So then November 1st, we've got the $818 going in, but $31.83 going out for taxes and $181 for mortgage insurance. So you can see month out, and so the balance is now $1909 because that $3,200 or $3,300 got dispersed, right? Then you see the account growing. Every month you've got the PMI coming out of that $818. And then come when the tax bill is due in February, that money is dispersed for the tax bill and $181 for the mortgage insurance. Then if we scooch down here, September of next year, the balance has grown, and the hazard insurance, which is the homeowners insurance, comes out of that account, and then also the mortgage insurance. So you see it growing. At the end of the year, she ends up exactly at $25.45, that a couple of pennies off that she started with. So what if the insurance goes up by $50? Then she's probably okay because she's got enough money left. What if the tax bill goes up by the full 2% that it can go up by? Then that might get tighter. So a year from now, on the anniversary of when she bought the property and got the loan, that money will be re-examined. Another analysis will be done. And then if there's a shortage, they'll let her know. If it's good, there's no discussion. So that is the escrow analysis, and you'll see this in your loan documents. If you have an impound account, if you choose to pay your own taxes and insurance and the loan allows it, you will not need one of these because the bank is not handling your taxes and insurance through the escrow or impound account. I hope this information is helpful. Have a great day.